Everybody focuses on how are these companies going to use AI to interact with their customers. But if they use AI internally and it gives them a couple points of EPS, what happens to the S&P EPS over the next 5 to 10 years, right? We get lift, we get tailwind. So I think that's a great point. And folks who want to bet AI and want to do it in a very simple way, own the mega cap, own the SPY, own QQQ. You're going to do well over the next decade.
Today's show is sponsored by Public.com. Public is an investing platform where members can build a portfolio of stocks, bonds, options, ETFs, crypto, and alternative assets, plus get an industry-leading 5.1% APY with a high-yield cash account. I have an account there, and so does my daughter Rachel. Public's high-yield cash account has one of the highest rates in the market. They have a higher interest rate than Robinhood, SoFi, Wealthfront, Betterment, Capital One, Marcus, Ally, Bank of America, Chase, Citi, Wells Fargo, Discover, and American Express. There are no fees, no subscription required, no minimum balance requirements, no maximum balance limits, and unlimited transfers and withdrawals. You also will receive 20 times the standard FDIC coverage of up to $5 million. Public also has recently launched options trading, where you can earn up to an 18-cent rebate per contract traded. To get started and learn more about Public, go to public.com/trends with friends. This is a paid endorsement for Public Investing. 5.1% APY as of March 26, 2024, and is subject to change. Full disclosures and terms and conditions can be found in the podcast description. U.S. members only. Welcome everybody to Trends with Friends. Week a lot. We one of these things. It's like Geranimals today. One of these things is not like the other. Can you spot the green screen? That is not. This is not.
It's like I'm being booked for a felony here in front of the height chart.
It's like Law and Order special version of Trends with Friends. We have. He's a very tall man. He's a handsome man. Just got a fresh haircut for Trends with Friends. Two people take hair seriously on this show. One is JC, who is, as usual, individually gelled 7,000 to 10,000 pieces of hair today. Thanks for making it, JC. And in the bottom right square, Don Rickles, Venture Capital. Jeff Richards, one of my probably one of the most guested people on Panic with Friends, and his first time on Trends with Friends. We don't have applause, but Jeff, thank you for joining. You're meeting JC for the first time, and Phil Pearlman. Strap on your seatbelt. Welcome aboard. And Phil Pearlman, who founded the Pearl Institute, and he's doing shameless shout-outs on his left breast today. So thanks, Phil, for joining. Sadly, each week we start looking more and more like each other, Phil. And may have to start doing the show when you start looking more like me and I start looking more like you. JC, how are the kids?
Everyone's great. I introduced them to the Sandlot. The other day, my little girl heard a kid talk about the Great Bambino, and she goes, Daddy, who's the Great Bambino? I'm like, I knew this day would come. So we sat down, we watched the Sandlot. She absolutely loved it. It was great. It was a special moment.
Oh, get to the Great Bambino. Is that not Tony Soprano?
The Colossus of Clout.
Oh, Donald J. Trump.
King of Crash.
More hint. I would like to call a friend on this one. Anyways, so Jeff Richards, GGV Capital, now Notable Capital. We'll throw up the logo. One of my favorite growth investors. We still have we invested in it? Well, we're about to do a tiny little personal deal together. But anyways, Jeff is long-time growth investor, Notable Capital, which is that the brand? Is that what are we looking at it properly?
It is. That's our new brand. So we renamed the firm, the U.S. entity, Notable Capital, and launched that at the end of March. So pretty excited about it. It's a project that I spearheaded internally, and as you can imagine, it's a lot of fun trying to come up with a new name that's not already taken. But we love this one because what it means to us is, we back notable people, we back notable ideas, we work for notable causes. Those are the LPs who give us the capital to invest. So it's pretty cool. It's not about us. It's about the people that we back and get a chance to work with, and has a lot of meaning for all of us.
Yeah. So you were in Silicon Valley. The fund's what? So do you count this from zero, or is this all still part of the billions?
You're
of
asking
dollars?
me very complex questions.
Is this part of the billions,
Yeah,
or is this a brand new operation?
The firm, our former named firm, GGV, has been around for 24 years, manages almost $10 billion. And so the partners in those funds will all continue to manage those together. And then going forward, we'll raise separate funds. So there's a team in Asia now called Granite Asia, which will raise capital to invest in Asia. And then the US team is now called Notable Capital, and we'll be investing in the US, Latin America, a little bit of India and Europe, but predominantly the US.
I think JC would be before we get into it, JC is going to be very excited about one of your investments, Slice. Tell JC a little bit about Slice. JC is our food. JC knows more about food than he does about hair gel. So tell him a little bit about Slice.
Well, JC, hopefully you're a loyal Slice user. It's the number one app to order pizza from independent merchants in the U.S. So pizza in the U.S., as you guys probably know, is the largest food category. It's about $50 billion a year. About half of that is Papa John's, Domino's, Pizza Hut, what we call big pizza. And the other half are local merchants, small businesses all over the country, usually people who own one shop, sometimes two, creating amazing, authentic, New York, Chicago, Detroit style pizza. And what Alir started this business about 14 years ago in 2010, and basically saw that Domino's was moving in this digital direction. Domino's, if you look at Domino's 15 years ago, almost none of their ordering was digital, mobile and web. Today, about 85% of their orders are over mobile and web. So they've gone hardcore digital. And what Alir did was created a platform for all the independent merchants to use and give consumers that same experience. So today, it's still a relatively small percentage of those independent merchants ordering. But we actually, on Slice, there are more independent locations on Slice today than there are Domino's locations. So hopefully Alir keep chugging along. We crossed over $1 billion of order volume last year. So we're handling a lot of pizza for a lot of families across the United States. And one of the things we love about this category, it's recession proof. People love pizza in good times and people love pizza in bad times. And it's just an incredible business. He's an incredibly authentic entrepreneur. One of the things I love to tell people is, Howard, as you know, in our business, you got to invest for the long run. And Alir, it took him 8 years to get to 5 million of annual revenue. And then in the next 5 years, he went from 5 to over 100. So it's one of those things where once you start to get some scale, you get a little network effect. The merchants love what you're doing. And then the other thing that's happening is merchants are realizing, DoorDash, Uber Eats, those are very expensive platforms for merchants. They take anywhere from 20 to 30% of the order value. And so a lot of them are getting rid of those as options and really encouraging their consumers to use Slice exclusively. So that's a great trend that we love to see. And we think this is going to be a really special company.
I think Thank you for
the plug.
Yeah, good plug. As we enter this new world, I've been talking about this on the show. JC loves and Phil love to invest as well. One of my favorite books is Shoe Dog, and it took him 10 years to get to 10 million in sales. And we went through this period, 2000 post GFC to 2021, where it was like, how do I get to be a unicorn overnight? And now we're out of that world, which is like, what's the point of being a unicorn if there's nothing behind it? So as we exit the SoftBank era and enter this other era, there's going to be a lot of opportunities for companies that kind of just didn't do anything for the first 7-8 years they built their brand. So it's an exciting time for our business, which we're going to talk about later. But JC, what's your favorite Slice right now, locally and in New York? Is there a place that you just would recommend?
I live in Eastern Pennsylvania, like in the Lehigh Valley, and at least where I live, the pizza is mostly unedible. I come from a particularly
Amish pizza.
The Amish are. I wish they were closer because they make good food, but no, around here, no. The Dutch, they just don't do it. You got to go into the city. I'm in the city once every couple of weeks. I try to get sushi and pizza as much as I can. I lived in California for 5 years, so I know about bad pizza. Like, I'm an expert at bad pizza. Like, Floppy Johnson, just a mess. And then you got these Chicago people with their casserole. like this, what is it? The Illuminati's or whatever.
The new one is
eat
Detroit.
that, man, is a
Yeah, Detroit's the new Chicago.
I actually had a great. I met the founder of Square Pie Guys, who lives out here. He's got 3 locations, and I actually had it. It was very good. It's thick.
Yeah,
it's a good 2 inches thick, but it was very good stuff.
By the way, Howard, random hole in the wall, New York City, $1 a slice, $2.
Yeah,
just hole in the wall, tiny little spot. You could see them like in the glass counters.
And it's usually next to like a weed store and a place selling suitcases out in front.
These days.
And there's a little amazing pizza place.
Well, yeah.
By the way, another plug for a book, Howard, Setting the Table by Danny Meyer, another great book. I keep it right here, along with Shoe Dog, both great books about founders.
Yeah, Setting the Table. And then the behavioral book, Phil, we got Kahneman's book, which is making the rounds again in this era of degenerate
Thinking Fast
economy.
and Slow.
Thinking Fast and Slow. There's 3 books that people should just go read. Thinking Fast and Slow, Danny Meyer's book, and Shoe Dog. All right, we're doing book recos. All right, let's get into it. We're going to get into the VC and private markets, but let's start at the top. JC, take us. Phil, you take it away, Phil.
Okay, so here's where we're going to go. Jeff, we're just play along, and then we're going to come back to you and have a little bit of a conversation about, private markets and SaaS
IPOs.
stocks, biotech, whatever, IPOs. But now, I mean, we have to go here, and I think we have good views here that are worthwhile for our watchers and listeners. And that is that yesterday there was a big bang in the meme stock degenerate space with the roaring kitty just coming out of nowhere, Cinderella story, coming out of nowhere. You remember that one? Coming out of nowhere and just tweeting again after all this time, like this guy who's looking up and paying attention. It's like everybody had attention. And GameStop and AMC just went lunatic right out of the gate, never turned back. I think they were up this morning again. We're taping this on Tuesday.
They were up
anybody
100%.
have takes here?
Yeah,
Go.
Let me start. Just because, first, kudos to Roaring Kitty. I don't know, Chess and Wine, Phil, I think I shared it. Chess showed the volatility kind of compression over the last year. Again, charts are easy in hindsight, but I mean, I wasn't in this trade. I've never traded this stock. Well, I'm sure I have, but,
Howard says I'm not a real investor because I trade these things.
No, bullshit. There's people that you have to pay tribute to this guy. He is much like Jim Simons. Obviously, he's the opposite of Jim Simons, but much like Jim Simons, who rarely gave interviews. No, who rarely gave interviews. You have to appreciate the scarcity that this guy has. This guy has an abundant amount of followers. He had an abundant amount of trust built up with his community. And what would a Chamath do, or a David Sachs do, or a Joe Rogan do, or anybody do with that much trust and abundance? They would talk all day, right? What did Jim Simons do? You never got interviews with him, right? Just the returns mattered. And so here we got the Roaring Kitty. They made a movie about him. The guy disappeared from social media since June of 2021. Okay. Imagine having that kind of influence and sitting on it for 3 years. This is an unbelievable thing. Like Kramer couldn't do it. So I think, Phil, it's a testament to short squeeze. It's a testament to the degenerate economy. It's a testament to how bad the SEC is. It's a testament to how fun degeneracy can be. It's a testament to the meme economy. And it's a testament to a person that's reinvented scarcity and trust to be able to not even mention the stock, right? And just have a picture of, here we are, of a lean forward guy in a red chair. Kudos, man. Fucking time that. Now, will he disappear for 3 more years and pull off? Matt Levine had the killer piece. I posted it today about setting up a Wharton class on the meme financial economy and the 15 answers to it. If you don't read that, you're crazy. So I hand it off to you, Phil or JC, and then we'll get to Jeff. What do you see here, JC?
So for me, it really just is a function of markets. And I think it's important. I think it's a good lesson for investors to recognize that markets don't simply move because of what's happening at the corporate level and the company. There are market dynamics involved that investors just need to understand. So, shareholders of companies and buyers of stocks, they're promising to be future sellers, right? That's all they're promising to do. But short sellers, if you have a short position, all you're guaranteeing is that you're going to be a future buyer, right? So the higher the short interest, right, the more buyers that are already inherently built into the situation. So what we do is that we like to sort by the short interest, in other words, the percentage of shares that are short in the overall float, but then we like to compare that number to the average daily volume so we can count, okay, theoretically, how many days would it take at an average volume for all of the short sellers to cover their short? The higher those days, in other words, it's called the short ratio, the more those days, the more the potential squeeze. Now, here's the caveat. Just because it has a high short interest, just because there's a lot of days to cover, doesn't mean the stock's going to go up. Remember, they're short for a reason. The company probably sucks. It's like a vending machine for cars or something, right? Like, these are the kinds of things that are on this list. Let's remember, these are mostly just terrible companies, theoretically. So what we like to do is we like to sort by rate of change and see when that momentum comes in, because that's when those dynamics come into play. When that momentum starts to pick up and those shorts start to unwind, the brokerages and the margin clerks are increasing their requirements. They're blowing people out of their trades. And here's the best part. These margin clerks, they're not setting limit orders. They don't have a fiduciary responsibility to the limited partner or to the stockholder or whatever it is. They're spraying the market with market orders. That's why these things start to fly. So if you can time the momentum increase while there's a high short ratio in place, that's the magic. And that's literally what this is. That's what we do.
I think that's great analysis. That's a level-headed, that is so looking at this list, and everybody can create these lists, but you've done a great job on the short squeeze list. You can almost front run and try and predict. Like today I wrote that Peloton, none of these degenerates are interested in fitness. And no matter how much short is in that company, no one wants to own it. Famous last words, but I wouldn't play that short squeeze because it's never been one of those candidates. But there's Reddit, Robinhood's, even though it's not short squeeze, obviously they're a beneficiary of this kind of silliness. What do you got in here? So if I was going to pick one, well, there's a few in here. Carvana's already had a great run.
Carvana,
Jeff,
I mean, listen, there's trades along the way. Carvana's up 2,000%. NVAX is up 350%, right? Just in the last few weeks, right? So these things are moving. So what we want to do is we want to create a universe and then go and pick out the best opportunities for us, depending on what the defined risk is, what the potential upside is. There are options trades. We put on a bull call spread on the DJT last week. That's working out great, because what ends up happening is that you have so much premium priced into these options so far out of the money, you can sell those against near out of the money calls, right? So you can help pay for those call options by selling them way out. So for example, in the DJT, our upside is limited now. We can only make 9 times our money. Only. I'm okay with that.
Yeah. So Jeff, anything, this isn't your world, but anything that, have you followed the story, or is it interesting to you at all?
I follow the story. I watched the movie. I think that the art of, as you described, Howard, of what he did with just a little image was brilliant. It was beautiful. He doesn't mention anything. In fact, it's kind of weird. The chair is red, everything. It's just, it's art. It is a world where I just don't play. As you know, I'm a very long-term investor. I don't think I've ever owned a stock for less than a few years. And so it's just a world I don't play in, but it is amazing how much it captures people's mind share very quickly. And to JC's point, it is, the market, is open for business, and folks can move it in creative ways. I think one thing that's interesting is, short sellers play a very important role in the market. Most short sellers, when they take a position, there's 2 types. There's the folks that are doing long-term research and finding a company they actually don't believe in the fundamentals on. And that's probably what you see with companies like Carvana or Peloton. And then you've got folks who are using shorts as a hedge, right? Most hedge funds have a short. They might be long Apple, short Facebook, or the opposite. And they're merely trying to capture a spread trade. And I think that's more commonly what the folks, that I deal with are doing. They're just using it as a hedge. But the folks that do deep research and go after companies that actually have fundamental flaws, I think it's a really important part of the market. when you see things like this, it exploits that vulnerability. You got I think I saw this morning on CNBC that shorts have lost $5 billion in the last 48 hours at GameStop, which is just, if you're to JC's point, you also have sort of unlimited exposure as a short, right? As a long, you can lose a certain amount of money, but you're somewhat capped. As a short, you've got this really awkward exposure. So it's just a really interesting phenomenon that I'm not sure anybody had planned for. And what was it? JC, you probably know the name of the firm that lost their ass the last time in this ordeal. Melvin Capital. Yeah. He was featured in the movie. Although I did see he just came back and brought. Well, he just came back and
then also like you could get it right. Like for example, like Silvergate had a huge short interest and they went to zero. So you can get them right just because they have doesn't mean that they're not going to be right. It goes to zero. It does happen. But man, like as a general rule, at least for me, people can do whatever they want with their money. I see a 30% short interest in a stock. There is 0.00 chance that I'm going to short that stock. It's not going to happen.
The other thing is here's what I don't understand. 5 billion is a real number. Is who professionally? The thing went from 600 to 10. Even if you think it's a zero, how much is enough? Like, again, I'm not saying I'm not saying the longs are right, but, this goes to not blowing up. There's a point where being short is just mathematically stupid. And that's what mazes me. I think the real story here is that this kid, without risking going to jail, moved a stock, 600% off a chair. Phil, behaviorally fascinate you? You don't care? I think you have to be fascinated.
Phil? Totally fascinating. Number one, I have 2 points to make. Number one,
Dr. Phil, by the way, Jeff, this is Dr. Phil.
It's always been that way. Like it's always like if you go back and you read Jesse Livermore and the whole, the markets have always been this way. This isn't anything. I mean, we call them meme stocks now. It's a lot of fun. Never had a Reddit before or a StockTwits before. So it's a lot of fun and it's open to everybody in the world. It's a global, ubiquitous phenomenon. But this is nothing really, really new. This is the way the psychology of markets always operated. Just go read Jesse Livermore. That's number one. Number two, anybody watching this right now, everybody watching this, some of you are experiencing insane FOMO right now. Like
for pizza or for GameStop?
Both.
For both.
Yeah.
Pizza and GameStop. You're like going, oh my God, I can't believe this is happening again. I missed it the last time. The guy down the road bought a new BMW because he made so much money following this guy on Reddit on GameStop. And, I don't know what to do. Here's the thing. There's that old expression about the poker game. Like if you're sitting at a poker table, you don't know who the mark is, you're the mark. Okay. So these guys are making a ton of money. There are people who know what they're doing. There are sharks in the water. JC is a sweetheart, but he's a shark, right? He's done this a million times. He manages his risk. He's talking about managing risk via options and limiting his upside to 9 times. Roaring Kitty legally figured out a way to take positions in all of these situations, tweet something that's a guy leaning forward in his seat, and he's making millions of dollars. What's a zero-sum game?
Well, you can't prove
he's losing.
You can't prove he made millions. I think the art of
can't
this
prove anything.
Doesn't matter.
I don't know
Doesn't
anything,
matter.
but I do know. Yeah. I do know the Barstool Sports guy yesterday. By midday afternoon, I got to his credit. He responded very quickly because this is a situation where, right?
What did he do? What did he do?
He was all over it.
He was all over it by noon. He had a video out. I'm in for $500,000 like that
in GameStop. Yeah. We made $1 million.
He's in.
He made
this
$1 million?
This is about action now. So if you're hesitating, if you're mulling, if you're thinking about it, if you've got to sell something else, if you're feeling FOMO from the guy who who bought himself a BMW, lives down the street last time around, you are the mark. And I just want to make that clear. It's responsible for us to say it.
Could be a good name of a show. We just have a guy.
And I want to mention one more thing.
We remind him that he's the mark.
I want to mention one more thing before we can get into the adult conversation. There's one more thing. First of all, you add up the market cap of all of these things, and it might as well be zero. So in the whole global market landscape, this is a rounding error, and that's putting it nicely. Number one. Number two, you see the equivalent moves, if not substantially more than that, in the derivatives market, just like this, every single day. It just doesn't make the headlines because Roaring Kitty isn't making a meme about it. But these trades and these 4 Sigma moves and all that stuff happens every single day. This is nothing new. There's just a meme of it now, so it gives people, the ability to tell stories. But again, this happens every day, and in the whole scheme of things of the global market landscape, it's irrelevant. It's a rounding error, putting it nicely.
Last word, and then I'll let Phil move on. The last word is, just like I said, everything's a rounding error. Who clamored to the attention? The master of attention, David Barstow, because that's what he does. He's a genius at that. So he put on a trick, ballsy guy, has the money, put on the trade, gets the attention. But you see the way he did it, the way you guys notice it as traders, he reacted. I don't follow him, but he reacted. And to the victors or the quick, go the spoils also sometimes.
The quick and the dead.
The losses. Yeah, quick and the dead. So, but the most important is for a guy to sit stealth for 3 years in a world where you can tweet and Instagram and Reddit and get all this attention and to disappear. Wow, that's an impressive samurai, very warrior-like move. So I think that's even though we can't prove it, that's the trade of the year. That what he's just moved around is a trade of the year. All right.
So we can have this discussion. Is there any difference between a meme stock and a meme coin? A few weeks back, we were talking about DJT. We were like, is it a meme stock? Is it a meme coin? Is it dessert topping? And
the press cover meme stocks. They don't cover meme coins.
I think they're more similar to JC's point. 3 weeks ago, I think they're more similar than not. Speaking of that, we want to get into actionable ideas. JC, Pepe the Frog coin. What's your, it's a relative.
Chuck E. Cheese.
Jeff, I'm glad you're laughing because we're tongue is half in cheek here, but we're talking about markets. Pepe the Frog is a beautiful relative outperformer. There you go. $3.7 billion market cap, not a micro cap. JC.
Yeah, no, I mean, I just wanted to show this because it's kind of just a sign of the times, right? Here we are talking about AMC doubling and everything like that. Pepe the Frog is worth double of what AMC is worth. Again, just to put things in perspective. Oh yeah,
no, it isn't.
Pepe the Frog is almost
Pepe,
it's almost $5 billion now pushing, and when you look, it made a new all-time high today. Actually, Pepe the Frog. Tuesday, about close to $5 billion, which makes it twice the market cap of AMC.
Jeff, this is what you missed.
So the point is that
Jeff.
It's not about Pepe the Frog or AMC or GME or Trump. These are all memes, and you're able to see the power of a community that has certain similar cultural beliefs for whatever that might be. It could be a frog or a former president or Roaring Kitty. They all have their stories. And it's not going to move real markets. Like, we're not talking about trillions of dollars. We're talking about $5 billion here, $10 billion there. It's
The only thing I would say, JC, that is a little frustrating for me is what tends to happen with these things is the mass population comes in late. So if you watch the movie, I forget the movie with Roaring Kitty, what it was called, but
it was so bad.
It was bad, but there were all these people that came in late, nurses and college students and whatnot. And they come in late and then they lose all their money. So I think these are entertaining, they're funny, but at some point, it runs up and then it goes down. And the people selling at the top are the ones that created the meme, and the ones who take all the losses are the folks that come in late. I just think that's the sad part of this equation. It's a little bit like the lottery. Who pays for the lottery? Lower end economic folks in America.
That's right? That's why we call it the degenerate economy. It's just we can't explain it.
But sadly, the momentum whips up, and then these folks come in. It's like NFTs. Yeah. It's like take your pick of phenomenons that have sort of built up a frenzy around them, and then the folks who inevitably lose the money are not the meme creators. They're not the pros. They're not the Dave Portnoys. They're the folks who come in late.
Yeah, but I will wrap this by Jeff. Generally, we say this is what happens near the top of things, not at the bottom. You don't see this behavior at the beginning of a bull run. You kind of see these things at weird moments in time when, like you just said, when CNBC starts talking about stupid things, and when we start talking about stupid things, it's more that we're trying to warn people, like, be careful. We've been talking for weeks about Goldman and Google. right? The real companies that are moving in this economy, real things that are moving, and companies that are moving in this economy. But it's a roaring kitty brings back a reminder, much like Trump, that culture and this abundance and scarcity thing. Like Trump's every day pounding the table, representing the brand and the troops that are out there buying 10 shares, 100 shares on dips. And then the opposite of that is Roaring Kitty, that has this mass following that is literally has an alert in case he says something. And at first, the people that probably didn't believe it. Like if you could also say maybe Elon hacked his account and posted that. Like there's a universe where you would have to believe that Roaring Kitty could come on and say that wasn't me.
The only thing I'd say
you'd
is
have to believe that
our media today is set up to focus on these outliers, right? Somebody gets killed in the crosswalk, we should all stop walking across the street. I mean, if you look at the campus protests that were happening recently, there's 15, 16 million kids in college. There were 2,000 arrested, and half of them weren't even college students. So 1,000 kids out of 15, 16 million. I've got a ton of friends. I've got a daughter in college. I've got a friend whose daughter just graduated from Michigan. Their graduation got disrupted by this. Very frustrating to the 99.9% of kids who weren't involved. And so I just, one of the unfortunate byproducts of the way social media works today, and even our media works today, we have to focus on these outlier stories and make them sound like it's happening everywhere. To JC's point, fluctuations in commodities and trades and options have been happening forever. This is not a new thing. But guess what? Every news outlet, even the Wall Street Journal, is going to focus on this GameStop story because it's entertaining. Right. But that leads the general masses to think, oh, it's everywhere.
Because the math,
and it's not.
Do the math. It's irrelevant. It's 5 billion here, 10 billion. It doesn't matter at all.
Right.
Yeah. All right, Phil.
Okay,
next.
You guys, let's talk a little bit about the IPO market and what's going on there. We're going to get into Jeff's wheelhouse. Anything you want to talk about, anything you want to ask him about it, how we go.
Jeff, what are we seeing? I know, to me, I'm seeing AI. I don't know. We're as a firm, social leverage is finance. We're thinking about AI. We're thinking about use cases of AI. I don't use ChatGPT. I know what JC does. I know Phil does. Do you use ChatGPT first and foremost?
I do. Yeah.
Okay. Are your kids using it in college?
They are.
Are they using it more?
Yeah, they're using it. They're using Perplexity. The kids, I'll tell you one thing that's pretty cool about all these technologies. Kids are using them right out of the gate.
Right out of the gate.
You don't have to tell them about it. They know about it.
So what is interesting? We went, when you were a guest and we were buying at the March 20 lows and you became a regular guest, we had this explosion of software and new economy and anything. We didn't die. So everybody was, let's get rich. Now we're at the point where interest rates are real. People are marking down stuff in portfolios. 3-year unicorns are being 10-year businesses that are cut in half and now have cap table weight and all these problems. How do we get out of this? What do you see?
Yeah. I've had this conversation a lot lately with LPs and folks in our fund and elsewhere. And the way I sort of think about it is if you're any of you guys fish, I love to fly fish. And if you're fishing, you see these confluences in rivers where there's like stream coming in from the right, stream coming in from the left. There's a bubble pattern over on the right. And it's hard to kind of figure out what's going on. And there's a ton going on below the surface. We're kind of in one of those modes where, Howard, as you pointed out, we had this huge run up in software pre-COVID. Then we had a whole bunch of pandemic stocks. You mentioned Peloton earlier. Obviously, the e-commerce bets like Shopify, which went way down or went way up, then went way down, and now has bounced back. And just a whole lot of fluctuation in the market. Look at Meta. That's been an incredible stock for the last 18 months once Zuck decided to quote unquote get lean or get fit. And then you've had this whole rush of new kind of AI, new wave of AI infrastructure that was getting funded early last year when ChatGPT launched. So it's really hard from the outside to make sense of it all. And I don't blame people for being wildly confused. The net of it, the way I would break it down is, one, I do think there's a sea change happening. So this AI is not new. Google, has been using AI and ML to run your search queries for 20 years. But this version of AI where it can deal with consumers in a very direct way, deal with natural language more easily. You guys may have seen yesterday, OpenAI demoed some of their new capabilities that are pretty mind-blowing around real-time language translation. So I do think this is going to transform the way we interface with our phones, we interface with compute, we interface with information. I think we're in the near term, it's overhyped, and it's like the internet, like mobile, like cloud. In the long term, which is not that long term away, maybe 2 to 3 years, it's underhyped. I think Apple's going to be a major player in this space. They've not really announced anything creative yet, but they've got a 2 billion installed users. So whatever they launch and whenever they launch it, it will be rapidly become the most widely used interface for AI. And I think that'll be a very interesting
Correct.
moment.
Like us, they benefit. They're so big, they benefit.
They benefit.
Just like
they
the
will,
consumer.
100%. And so, whether they buy somebody, which is hard to do with the current FTC, create their own, seems like they're a little far behind. The news is that they gave up on the self-driving car project they were working on and have now devoted those resources towards AI. This is a transformational technology. We're already seeing it. Every major Fortune 500 company is investing in this area. It's not showing up yet in the software and technology company earnings because most of these are sort of like alpha/beta projects. But every company knows if they don't invest in this, they're going to be dead in 3 to 5 years. Not because new incumbent upstarts are going to beat them, but because their peers, whether it's, if you're in banking, it's Goldman investing heavily in AI, or if you're in auto, it's, Tesla investing heavily in AI. It's unquestionably going to change not only the way you interface with your customers, but also the way your internal operations work, right? I'm not going to need as many people doing customer service. I'm not going to need as many people doing accounting, finance, sales, marketing. I think this is the very beginning of a little bit of a white collar, I wouldn't call it a recession, but it's definitely going to be a headwind on hiring. I tweeted this out last year. I think we saw peak big tech hiring about 18 months ago. Companies are realizing they can do a lot more with less now that they've got these tools and technology. If you look at the developer space, you've got copilots, which can make a developer 30, 50, 100% more productive. The area where I think this is going to have a big boom for our economy and nobody's talking about is small business. If you run a 10-person shop today and your cousin, your nieces and nephews work there, your daughter runs the store, you don't have anybody doing accounting, finance, sales, marketing, bookkeeping. The owner is typically doing all that work themselves. And so I think there'll be a set of tools that'll come out, and they'll come out from the existing software vendors, whether that's, a Shopify, a Homebase, a Slice, who we talked about earlier, Brightwheel, HubSpot. These companies that already provide the tools to small businesses are going to launch features and functionality with AI that will turbocharge the productivity of those businesses. And so what I'm excited about is, 42% of US GDP is SMB in the United States. 42% of our economy is SMB, 55% of employment. So if we turbocharge that sector of economy, this is one of the reasons why I'm bullish and I'm long the market. I think it's going to have a really positive economic impact on the country. I contrast that with, I do think we're going to have a near-term existential issue around white-collar hiring, just because I think some of those basic functions I talked about a minute ago, are going to get automated with AI. And so interestingly, it's not going to have as big an impact on the lower end of the labor market. It's going to have a big impact on the higher end.
I tell my son and young kids coming to be recruited, I'm like, AI won't disrupt sales ability. If you can do sales and marketing, which no one's been studying the last 10 years, everybody want to be an engineer. And if you believe Jensen Huang, NVIDIA guy, goes, we won't need engineers theoretically. The chip will do all that now, of course. You're always going to need design. You're always going to need some engineering. But I think we're in short supply of sales and marketing. Thank God white collar people have to get their act together, can retrain themselves and look people in the eye and do sales and marketing. Not so easy for those same white collar people to become engineers
or start a company, right? That's what I'm telling my daughters in college. Be ready to start a company. It has never been easier to start a company. All the tools are out there that didn't even exist 15 years ago, right? Square, Shopify, Squarespace, GoDaddy, HubSpot, all these tools that are now at your disposal to start and run a business on a shoestring budget. Starting a business 20 years ago cost you, tens, if not hundreds of thousands of dollars. Today, you can literally launch a Shopify store or some other type of business for a couple $100. There's never been and you've seen it in the last 3 years. We had 15 million new business applications in America. I don't think that's an accident. Part of that is a post-pandemic shift in the way, people want to work. They want to do more work from home. But part of that is also just the fact that those tools are available to them that weren't there 15 years ago.
Yeah, well, everybody in this room, you're changing, you adding Notable, us, me back running StockTwits. We're seeing all that in a smaller scale at StockTwits. I would ask you how Slice is doing, but at StockTwits, part of the excitement of coming back and doing the show and everything as we think through AI is, the LLM's going to do the work for StockTwits. That's 16. I didn't know how to hire 10 data scientists Now everybody's working for me. And, you know, my 16 years of data, our 16 years of data stock, it becomes interesting because machines can go back and do the work that people would have to do. And so that's exciting. But you're right. Like at the same time, StockTwits can go cut its, you know, workforce in half because of all this, right? Maybe we were overstaffed to begin with post COVID, to the fact that, you know, we see the future too. And you go from, you know, with half the amount of people. And Slice, how are they think about AI in a board meeting? Like just one example.
Every single,
or is it still too early?
No, it's not too early. Every single company I'm involved in is rolling out products and features for their customers that have AI embedded. So at Slice, what you'll probably see from us initially is a set of tools to help merchants do better at sales and marketing, right? If you're a small pizza owner in, you know, Indiana or Pleasanton, California, where I live, sales and marketing has not traditionally been your bailiwick, right? You sponsor a local baseball team, you maybe run some flyers, did a little bit of online marketing, but it wasn't really your thing. We can give you a set of tools that will completely automate that for you. Say, how much do you want to spend? We can show you the return on your spend. We can show you who's showing up in the shop because we see the order flow. So there's going to be some really interesting capabilities here.
Love that.
And look at Intuit. Intuit's touting their AI capabilities. I mean, what a pain in the ass it is as a small business owner to do your taxes. They're rolling out AI functionality. Says, look, we'll automate that. We'll do your taxes in real time. Every month when you settle your books, we'll just calculate your taxes and you'll know exactly what you owe every month, every quarter. I think this is going to be for the folks who can take advantage of it. And remember, wind back the clock 15 years ago, most small businesses in America didn't even have internet access in their shop. What changed that was the iPhone. Suddenly you gave them a massive computer in their hand and they said, I can run my business on this. And then a whole bunch of companies like Square and Intuit and Shopify and others built the tools for them to do that. And so today, these businesses are far more technically savvy than they were even 5 years ago. So they're ready when these features and functionality, when I talk to, like I mentioned, I met with the founder of Square Pie Guys here in the Bay Area. He owns 3 shops. He's super aggressive on DoorDash. He's super aggressive on Uber Eats. He's embracing tools from Slice. I asked him about AI. He said, I'm already beta testing this. I'm trialing this. That never would have happened 15 years ago. So I just think it's going to be a turbocharger for the small business economy in the U.S., which is going to be good for the U.S. economy broadly.
Love that answer, because my wife and I basically started 2 businesses, one each. And all we have is a Mac, Google Hangouts, email account, and QuickBooks. And we're profitable, running the businesses, growing them. It's the easiest thing in the world. Our quality of life is insane. We have 0 commute. It's ridiculous. And it's and we're simpletons. We're not even that smart of people. And we're just doing it. And exactly to your point, what you're saying, it's intuitive. Like you don't have to be an engineer or a brain surgeon to be able to just leverage these almost plug and play tools.
At the same time, though, Phil, just pull up the chart and then we'll switch to some ideas. Pull up the chart, and this goes to Jeff and my job. Never been more. Now, granted, never there been more people starting businesses, but there's never been more wind downs in the VC market, right? And zombies. And so, how does this play out, Jeff? Startup shutting down again. Let's assume the data is true. It's from Carta. Now, granted, the data is skewed because you also had more stupidity and more companies being funded. But here we are, directionally accurate, despite the cloud, despite that it's bringing costs down, despite all that's going on. Look at these numbers, right? Capital's still massively abundant. Interest rates are 7%. Companies are shutting out the wazoo, and the degenerate economy lives. So more than one thing can be true. Like we are seeing things in this economy that defy old textbook stuff. What do you see when you see this chart, and how does it affect how you see the funnel and IPOs and quickly?
Yeah, there's a couple things happening here. One, you had more companies funded. So if you have more companies funded and you keep the failure rate the same, which in our business we generally think of as 80, 90%, you're going to have more failures on the other side. That's one element. 2, there are a lot of companies that did not get the memo in 22 that the world had changed and that capital was no longer abundant in a post-zero interest rate environment. It was so easy to raise money in 2021. I mean, literally, you didn't even have to have a great idea. There was so much money chasing private companies that you could raise money very easily. It completely pulled a 180 in 22. And in 23, it was nearly impossible to raise money for startups. So what you're seeing is people now run out of the capital that they raised in 20 and 21. And then most notably, as you mentioned, Howard, there were 1,400 companies that were quote unquote unicorns valued at over $1 billion. I have been very public in saying I think less than 10% of those will be worth $1 billion when it's all said and done, because many of them did not have long-term, durable, sustainable business models. They had business models that were very geared towards raising capital, i.e. I raise 100 million, I spend it to grow very quickly. But do I have a product that customers really love? Do I have a business model that has high gross margins that can fund itself with cash flow? And so what you're seeing is out of the ashes of all that unicorn funding is companies emerging who are truly great. You've got the Canvas, the Ripplings, the Databricks of the world that were in that class and are truly great companies. But you're seeing companies like Convoy and others that are having to shut down because they didn't really have a viable business model. And then you've got a whole third set of companies, which are companies that nobody had heard of, that stuck to their knitting, continued to build a great business. You mentioned Slice. I've got one called Homebase that just raised. We had a company go public called Ibotta. Most people had never heard of Ibotta. Well, guess what? Brian had a B2C business model. He pivoted the business model in the last couple of years to more of a B2B model and went public, and the company's worth a couple of $1 billion and it's done very well so far as a public company.
What did they do? I bought a new Porsche. Is that what Ibotta means? You
it's
say
sort
it
of a play on
happen?
that. But they help companies like Walmart create loyalty programs with their consumers. And so not the most sexy company, but great operator, great founder,
Sales
CEO,
and marketing.
Sales and marketing. And so I think what you're going to have, and we've been talking about this with our LPs, if you were a FOMO late stage fund that was dumping money into unicorns, and Mark Suster had a great stat where he said that over 700 of those 1,400 companies, the valuation was set by just 4 firms. One of them was SoftBank, and you can guess the other 3.
Tiger, Coatue, who was the 4th?
Set
Tiger, Coatue, T. Rowe?
No,
Tiger,
there's another firm in
Coatue,
the mix.
SoftBank, and Andreessen.
You're not far off. But the point is, if you were among that cohort of firms that were just investing in that asset class, yes, it's going to be a really challenging few years for you. But if you were doing traditional venture capital, which is what we do, what most of the people that you talk to do, Howard, 75% of what we do is Series A and B. Those companies are still really early in their J curve. And a lot of them are going to be way more capital efficient. The founders are going to own more of the business. We're going to own more of the business because they're not going to go on and raise as much capital. Most of the founders I'm backing today at Series A, B, and C are saying, hey, this could be the last round of capital I raise. They don't have stars in their eyes about raising $100 million from SoftBank. So I think this era is going to produce some really exceptional returns once we get through the sort of cleansing of the last era. And you're going to see a bunch of companies that hit the market. They probably won't be going public this year, but 25, 26, 27, there'll be a bunch of companies that surprise people that were never on anybody's unicorn list that you're going to want to own, and you're going to own them for 5 to 10 years because they're going to compound at 30, 40, 50% and build great companies.
Yeah, the Ibottas of the world. Okay, these are all great points. We'll have you back. And then biotech quickly. I didn't know you even looked at the space. So what do you see?
Biotech? I don't.
I think you mentioned.
I'm the last person you should have on to talk about biotech.
Okay, good. No. I thought I saw that in the notes. So good. I didn't think you do.
Howard actually.
Sadly,
here's a funny thing.
Here's the
Howard
scarcity
actually
thing.
put that in the notes. He actually put that in the notes. Like he was like,
because here's where scarcity. No. But here's where scarcity comes in because we're all
hairstyling and biotech. Two things I know nothing about, as you can tell.
Well, everybody's selling blue pills because it's commodity. But here's where it's interesting. No one's looking there, right? No one wants to look there because we don't know how they work. We don't have the patience to spend with FDA. We're all hoping to have a fat pill, and we got a fat pill. So I think the next boom is lining up to be biotech. We'll have to have a couple experts on. I'm seeing private companies raise $1 billion in the space. The Genentech guy the scientist went and started a new company, raised $1 billion. You would think all this stuff applies. We want to live longer. We want better hair. We want to not work out and have sex.
We need a Viagra for golf. Lower your handicap 5 points.
It's called pickleball. It's called pickleball. The Viagra for golf was pickleball, and the orthopedic surgeons win that. So
okay,
Phil,
so let's get into some ideas that are actionable. And so I'm going to start it, and then I'm going to shut up. I'm going to start it with a question for you guys, for Jeff and everybody. So we were talking about AI before, and here's my question. I'm dumb, but I'm also patient, right? I'm a dumb, patient guy. And so I'm curious to understand how I play the AI boom. That may take a while. It may have contractions. I understand that. But how do I play in public markets AI boom over the long term? Any thoughts?
Jeff, JC.
I mean, I'm gonna give I think you ignore it completely. I think that the companies that are going to win the most are the big companies that are winning in a lot of other ways. So kind of takes away the pure play. You've seen that from the start. All the pure plays have been underperformers. All the big ones that are doing a whole bunch of other stuff are winning. So by owning those companies like Google, I think you're participating in that. So as investors, particularly those thinking for the long term, think like that and then just ignore it because I have a chart right here. You can see what's been happening all year, really particularly since March there, where you're seeing that, technology, consumer discretionary, these are the groups of stocks that have done the worst on a rolling 10-week period. And it's really the rocks that are working. We've been seeing this sort of transition and rotation, so it's the rocks, things like copper, silver, gold, those things are working. The NASDAQ's losing people money. Bitcoin, consumer discretionary on an equally weighted basis, large caps, small caps, same thing with tech. Small cap tech is the worst place to be over the last 5 months, certainly over the last 3 months. I think that this rotation, probably continues for a while. That's how I'm thinking about it.
Dude, that's so good. I'm gonna say Goldman, meaning Okay, so I'm making a big change here over the last months, as you know. I still believe in direct indexing. I think in a choppy market, take those losses that direct indexing gives you over the next 6 months to 2 years, right? So I'm still very bullish on, the idea of indexing. I'm still very bullish on the idea now of direct indexing. Shout out to Freck.com, one of our companies. But also I'm leaning more towards SPY, which has some rocks, even though it doesn't have a locks and energy. I'm leaning more into SPY over QQQ here for my average new dollar into the market, because that goes more in tune with Goldman and Google, which covers AI, which covers China a little bit. Goldman and capital markets is got no competition as the world shrinks. When you got to buy something from the Chinese, you can't go on Robinhood, you can't go on Schwab, you got to call Goldman, better get Mako. And the Chinese are buying gold, and there's going to be all kinds of problems when we try and buy it back. So I think it's the SPY over the QQQ, which covers a little bit of AI, which covers a little bit of metals. Jeff, any big ideas there for Phil? Like long term?
Well, first of all, on the AI trend, Phil, I agree with JC. The guys that are going to win big in the near term are the big players. It's Amazon, it's Google, Facebook, Meta.
They have the money to spend.
Amazon, because they have the money. I mean, this is a big boy CapEx game. If you think about this, I put a tweet out the other day just about the CapEx spending among the Mag 7. It dwarfs anything in any other category, and it dwarfs countries, right? Microsoft is spending over $50 billion a year on infrastructure. I mean, our government is only spending federal government, 110 billion on infrastructure, on roads and airways. Wow. Isn't that crazy?
Wow.
So they win in the near term. And then what's going to happen is they're going to build the highways for the next phase of growth in AI. And you will see some software and application players win there. It's just a little early. And to JC's point, the small cap names in that space have been getting crushed because there just hasn't been any lift. They're also battling, when I go back to the point I made earlier about the white collar headwind in hiring, if you're a seat-based software company, that means there's potentially less seats to buy your software or to sell your software into. And so there's a little bit of a headwind there in the near term. At a broader level, own QQQ because you're going to own those names if you own it. I like it. I've owned it forever. Thank God I've never sold a share. I just keep buying more, and it's up like 7 or 8x in the last 10 years. I love a non-tech category that I've tweeted quite a bit about is the PE sort of, non-banking sector financial players. So KKR, Blue Owl, TPG, Blackstone, Ares. I pulled up the numbers before we got on today. And I tweeted this out in December of 22, so I'm not making this up. I said that's the category I'd be buying, and I'd be buying it for a couple of reasons. One, When rates go down, they benefit. Two, you have an inevitable flow of capital going into private markets. The amount of capital going into private markets over the last 3 years has grown more than 3x in 10 years to $11.8 trillion. So these guys win as more money comes into private markets. And then I think they're going to be buying assets on the cheap. One thing I didn't see coming was the SVB failure about a year ago. Well, that also put more regulation around the banking sector. And so what you've seen is this explosion of private credit. These guys win in that space, right? Businesses, small businesses, mid-sized businesses, mid-cap businesses that need to borrow 50, 100 million are increasingly going to these firms for that capital as opposed to a Wells Fargo or Bank of America. So I love that trend.
That goes to my capital Goldman.
Yeah, I love that trend.
I'm making it. I'm calling it the three Gs just to make it cool. Well, I'm saying, it's representative of what you're saying, meaning I'm only calling it the three Gs instead of the three Qs. That's
so the names I like, I own KKR, Blue Owl, TPG, Blackstone, Ares, Brookfield Asset Management, Goldman. The other thing that's nice about owning these names, you get paid a dividend along the way. And guess who makes a lot of money off the dividends in these names? The partners in the firm. Steve Schwarzman makes over $1 billion a year in dividends from Blackstone. So I like to tell people, I like being a partner with billionaires, right? And if you're a retired partner at one of these firms, guess what? You hold on to that equity because you get paid a lot in dividends. So those dividends tend to grow over time. If you're growing earnings at 10, 15, 20% a year, you're paying out more in dividends. You can really do well owning these names, which then leads me to an ETF that I like called VIG. So VIG is a Vanguard income growth. The VIG.
And, Phil.
And a lot of
Phil, you just got Phil
Horny. A lot of people compare it with SCHD, and I own both. I like both. But what I love about VIG is they're actually growth companies. They're companies that are growing that dividend every year. And over the long run, you're making money on the equity appreciation as well as you're making more on the dividend. So I love those in the ETF world along with SPY and QQQ.
All right. So we could, Phil, go quickly to this, goes Jeff to what we say. Hopefully, JC can hang a couple of minutes. Trends with no friends. Part of what we think this market has become, Jeff, is, of course, if you want to own the trend, own the big guys because they have the money to spend. So you stated that very clearly, and maybe we failed to do that over the last few months, but that really does state it clearly. But if you don't own, those are the trends with friends. Like the market cap is your friend, the way the market's wired for. But below that, it's what's really interesting. There's so much momentum in trends with what I call them no friends, few followers, and I'm not saying they're not owned in the S&P. They just have few followers in the mainstream. They're not followed on stock twits. Phil, a couple that just blew my mind. Again, we've built this list, Jeff, called Trends with No Friends, which it takes the highest relative strength stocks with the least amount, over $1 billion, with the least amount of stock twits followers, right? So it's kind of contra indicator. It's like no one cares. And we find those trends have less volatility and no one cares. And eventually they will care if this company executes. So the stocks tend to continue to go up. Phil, what stood out this week on the list?
Yeah, this is like a slow motion noise arbitrage relative to what we were talking about before with GameStop or AMC, which is sort of a fast motion noise arbitrage. One, Riley phoned these in today. He sent us the charts. One of them is called Bluebird BLBD. It only has 1,100 followers on StockTwits. These guys are as boring a company as you'd ever want. They make school buses. And, go look it up. It's got about a $2 billion market cap or a $1.8 billion market cap. And all they do is make school buses. And, just look at that candle. Like nobody's watching this thing, but it just blew out. And we were talking about it. We were talking a few weeks ago.
What's the reason? Did something change in the business?
Well, again, infrastructure span, right?
Wow.
Hamas blew up a lot of school buses too. So, but the school buses, there is no story, right, Jeff? The great thing about these things is price is telling you to take a look. Right, the base, the price.
There's a story there, and nobody knows it, which is a beautiful
story there. Just no one is telling the story.
Like this,
you have
it's
to
not like
piece
this
together
over media.
the
like earlier today, we were talking about this over media.
Yeah, because there's no frog associated with it. So
yeah, there's no frog. That's the story. No frog.
There's no frog.
If this thing was called Blue Pepe, this thing would be awesome. Triple the price.
Riley pointed out actually that they're all.
We've been doing this for months.
There's a cluster of them that are education plays. So 2 weeks ago, Trends with No Friends was Aramark, which supplies food to like colleges and stuff. That chart is off
Huge
the handle.
company.
It's got like 600 followers on StockTwits. He also put Bluebird, and then also Nelnet, which has
This thing's unbelievable.
300
This is a
followers
scam
on
of a company.
StockTwits. So completely under the radar, and it's carrying $500 billion in federal student loans. And look at that chart. Like, look at
They're
that.
like the Fannie Mae of student loans, right? And now the student loans are back in play. That's the story, right? People have to start paying again. So they just have a monopoly business that was forgotten about for 6-7 years, and now they're going to ring the registers.
By the way, another interesting category, and I don't own anything in this space, but I've been reading a little bit about it. There's a bunch of institutional players now that own real estate near college campuses. So apartment rentals near college campuses. As somebody who has a now junior in college, talk about a monopoly. These folks start buying up all these properties. There's a guaranteed influx of renters every year. Mom and dad are paying the bill. It's an incredible business. Incredible business.
Huh. Yeah. So listen, Google, like I said, you want to play market cap because market cap is the trend that you have to own because money pours in every month from our, 401ks, blah, blah, blah. The QQQ,
By the way, people
SPY.
underestimate that there's trillions and trillions of dollars in 401k assets. The majority of it is coming into equities every single year. It comes in reliably, and it is a reliable tailwind on the market. Don't bet against that trend.
Yeah. I think, yeah.
Related to that, Jeff,
ahead,
like what you were saying before about VIG and playing these companies that are just behemoth companies that are right in the middle of what's happening with AI, there's a downstream to that. And, even if you're just playing a SPY or a VTI, which is like a total market index, the best companies eventually, even if they're not technology companies, even if they're logistic companies, even if they're retail companies, even if they're whatever, they are going to also benefit from AI as they add efficiencies with these tools and with this technology over time.
Just one thing I would add there, Phil, and I think that's everybody focuses on how are these companies going to use AI to interact with their customers. But if they use AI internally and it gives them a couple points of EPS, what happens to the S&P EPS over the next 5 to 10 years, right? We get lift, we get tailwind. So I think that's a great point. And folks who want to bet AI and want to do it in a very simple way, own the mega cap, own the SPY, own QQQ. You're going to do well over the next decade. You're going to have some drawdowns. You're going to have drawdowns like we had in March 2020, which was one of the great drawdowns of my life, Howard. And you were lucky to have, or I was lucky to be on with you and talking about it. But when you see those drawdown moments, come back in because this trend is not going away.
Yeah, the drawdown is. You hope for the drawdown because then your thesis is you could have better time to collect stories. You build stories right now to buy the drawdowns. JC, any option trade before we go?
Mostly just kind of how you want to think about it. So 2 quick things to think about. Number one, with volatility super compressed, you're seeing the super low VIX readings, and then the volatility of the volatility is super low. So premiums are so cheap. Nobody wants to buy insurance. Like you're not seeing any demand at all for protection, downside protection at all. I'm not quite doing that, but protecting assets as I am, taking advantage of that low volatility. And you could buy call options really far out into the future because volatility is so cheap. So that's how I'm thinking about it. To Jeff's point, talking about capital markets, look at Rocket Mortgages, RKT. We bought some out of the money call options there. And then in terms of the meme stuff, these premiums are so juiced up, crazy out of the money, right? So what you can do is you can finance call options that are much more approachable, closer out of the money. You can finance those by selling the ones way out. You're capping your potential gain to maybe only 5x or 10x. But if that's okay, and you're okay making only 5x or 10x, which I definitely am, think about it like that. Use those juicy premiums to help finance more normal trades. That's how I think about it. You like that?
Perfect ending. Thank you very much, Jeff. Pleasure talking with you and pleasure meeting with you. Howard took a little quick goodbye there. I think his internet connection cut off or anything. JC, you're the man as usual. I will talk to you later this week. Adios.
Thanks, guys. Great to see you.